Welcome to Breaking News to Trading Moves. Today we are looking squarely at the latest quarterly report from Nvidia, ticker NVDA. The numbers are out and the guidance is set.
Yeah, and the market reaction has been, well, let's call it contained.
It was a very classic sell the news setup. I mean, even though the news itself was objectively strong.
Right. We have to start with that headline number. Nvidia has guided next quarter's revenue to approximately $78 billion.
Which beat Wall Street estimates. In a vacuum, you would think the stock screams higher on that, but it didn't.
It sort of just shrugged.
Exactly. So why are traders sitting on their hands with a $78 billion guide?
It really comes down to the difference between a beat and a surprise. We have reached a maturity phase with Nvidia where the market has modeled out these growth rates.
Everyone knows the demand is there.
Right, so a beat of $1 billion or $2 billion here or there is already baked into the price. Investors were looking for something extra.
Like a clearer signal on capital returns, maybe? A bigger buyback program or a dividend hike?
They wanted cash back in their pockets. But Nvidia is doing the exact opposite.
They are prioritizing reinvestment. They're taking that cash and pouring it right back into the supply chain.
To secure inventory and manufacturing capacity, yes. They are essentially telling the market that they see so much demand they need to spend every dollar they make to build more chips.
Which is the responsible thing to do if you are running a business, but maybe not the fun thing to do if you are a short-term trader looking for a quick pop.
Precisely. But here is the signal we need to focus on. Forget the stock price reaction for a second and look at what that $78 billion actually represents.
It is a direct transfer of wealth from the hyperscalers, right? The Amazons, the Microsofts, the Googles.
Directly to Nvidia, it confirms that the infrastructure build-out is not slowing down at all.
And Nvidia says they have the capacity to meet it. So if we know the money is leaving the hyperscalers and landing in Nvidia's bank account, it doesn't just stay there.
It has to flow downstream. And that is where the tradable ideas are right now. NVIDIA is the sun, but we need to look at the planets orbiting it.
The first beneficiaries are the companies that actually take that chip and turn it into a functional computer.
The system builders.
Right, because you can't just buy a Blackwell chip and plug it into a wall socket. These things are incredibly complex, and they need to be housed in specific high-density server racks.
This brings us to the AI infrastructure and systems winners. The obvious one that traders love is Supermicrocomputer ticker SMCI.
But you also have the enterprise heavyweights in there. Dell Technologies, ticker DELL, and Hewlett-Packard Enterprise, ticker HPE.
I think people sometimes overlook Dell and HPE as just legacy PC makers, but they are moving a lot of metal here.
A lot of high-margin metal, too. The narrative has moved beyond just buying a standalone server. We're talking about rack-scale solutions now.
Exactly. When NVIDIA ships a high-end chip, it generates a massive amount of heat and requires precise power delivery.
So Dell and Supermicro aren't just bending sheet metal. They are engineering the thermal airflow and the power regulation modules that keep these chips from frying.
So if NVIDIA's guidance says they are shipping more units by definition, Dell and Supermicro have to ship more boxes.
It's a one-to-one relationship. You cannot have the chip without the chassis.
And because the complexity of these chassis is going up, the average selling price for these servers is going up too. It is a volume story and a pricing story for the hardware vendors.
Okay, so we have the chips in the box, but a single box doesn't build a massive language model. You need thousands of them working together seamlessly.
And that is where the bottleneck usually hits. This brings us to our second category, which is networking and connectivity.
The plumbing, basically.
The plumbing, yes. But it is high-speed optical plumbing. Think about it this way. The GPU is the brain doing the thinking.
But if the nerves connecting the brain cells are slow, it doesn't matter how smart the brain is. The system will lag.
And in AI, training lag is money lost. When you are training a model across 10,000 GPUs, they all need to share data instantly.
Right. If the network switch is slow, those $30,000 chips sit idle, just waiting for data. That is a disaster for efficiency.
So the spending on high-end networking gear is escalating just as fast as the spending on the chips themselves.
Who are the winners in that scenario? We are looking at Arista Networks, right? Ticker ANET.
They are the leader in high-throughput data center switching. Then you have the component suppliers like Broadcom, ticker AVGO, and Marvell Technology, ticker MRVL.
Broadcom and Marvell seem to be in absolutely everything these days.
They are the shovels in this gold rush for sure. Specifically, we are watching the optical interconnects.
Because as these data centers get bigger, you can't use traditional copper wires to connect the racks anymore. Copper gets too hot and the signal degrades over distance.
You have to switch to optics, lasers, and glass.
And Broadcom and Marvell make the custom silicon that drives those lasers.
Exactly. If NVIDIA's revenue is going up, it means more data is moving. If more data is moving, Arista is selling more switches, and Broadcom is selling more optical drivers.
It is a derivative trade, but the correlation is incredibly tight. It sounds like the plumbing is actually just high-tech physics.
It is. And speaking of physics, that leads us to the third group of winners. This might be the most durable trend of them all: power and cooling.
We keep hearing that these AI data centers are energy hogs. But let's give people the scale here. Why is this such a major constraint?
The density is the real issue. In a traditional data center, the kind that hosts your email or a basic website, a server rack, might draw 10, maybe 15 kilowatts of power.
But the new Nvidia racks are pushing towards 100 kilowatts per rack or even more.
That is almost a tenfold increase in energy in the exact same physical footprint.
And when you pump that much electricity into a silicon chip, it turns into heat immediately. If you use standard air conditioning, just blowing cold air from the floor, it doesn't work.
The air simply can't move fast enough to strip the heat away. The chips will throttle down or just fail outright.
So you have to change the physics of how you cool the room. You have to move to liquid cooling.
Right. You need fluid running directly to the chip or through a heat exchanger on the rear door of the rack. This is a complete architectural overhaul for data centers.
And who are the specialists stepping in here?
The pure play is Vertiv, ticker VRT. They focus almost entirely on thermal management and power infrastructure for data centers.
They've been solving this high-density cooling problem for a while now. I also see Eaton on the list, ticker ETN.
Eaton handles the power distribution side of things. Getting the electricity from the utility hookup to the actual rack requires massive transformer switchgear and backup power supplies.
Because you can't have a random power spike fry a billion-dollar computing cluster.
Exactly. And then you have Quanta Services, ticker PWR.
Quanta is more on the grid side and the physical installation, right?
Yes, but think about the bottleneck here. You can manufacture a chip in a few months. It takes years to upgrade a power grid or build a new electrical substation.
So power availability is actually becoming a bigger hurdle than chip availability.
It really is. So these companies, Vertiv, Eaton, Quanta, they have major pricing power because there is literally no alternative. You either buy their gear or you don't turn on the machine.
That makes total sense. NVIDIA's $78 billion guide effectively confirms a massive order book for air conditioning, liquid pumps, and circuit breakers.
That is the thesis.
Okay, so that covers the winners. The ecosystem is very healthy, but trading is a zero-sum game in many ways. If NVIDIA is winning, who is having a hard time competing for attention?
We have to look at the competing narratives.
Yeah.
The other chip makers, primarily.
Advanced Micro Devices and Intel.
Yes. AMD ticker AMD and Intel ticker INTC.
Now, AMD has a competitive chip. It's not like they're entirely out of the game.
They are absolutely in the game. But the problem is momentum and market share. When NVIDIA guides this high, it confirms they are capturing almost 100% of the incremental spend.
Every dollar a hyperscaler spends on an NVIDIA Blackwell is a dollar they didn't spend on an AMD equivalent. It's a strict opportunity cost.
Exactly. The narrative for AMD has been about playing catch-up. But it is really hard to catch up when the market leader is actually accelerating away from you.
And for Intel, the story is even harder because they are trying to fix their foundry business while also competing on the chip design side.
NVIDIA's strength just highlights how far ahead they are in the data center space. It sucks the oxygen out of the room for the other semiconductor stocks.
It does. Unless AMD or Intel can show a surprise win or a major new customer, the default trade for most people is just to stick with the clear leader.
That's the reality of the tape right now.
What about the software side? We always hear the phrase software eats the world. But right now it feels like hardware is eating the software's margins.
That is exactly what is happening. We call this the AI software and applications squeeze.
We are looking at companies like C3.ai, ticker AI, or SoundHound AI, ticker SOUN.
Right.
Why does a booming AI market actually hurt AI software companies? That seems counterintuitive at first glance.
It comes down to the cost of goods sold. For a software company, their raw material is compute power. They need to rent GPUs to run their algorithms.
And because NVIDIA is so dominant and demand is so high, the price to rent that compute remains astronomically high.
So their rent is going up constantly. But can they raise prices on their own end customers to compensate?
That is the struggle. They're trying to build viable business models on top of very expensive infrastructure.
Until compute gets cheaper, these application layer companies are going to see their margins heavily compressed. They are basically paying an Nvidia tax on everything they do.
The hardware guys get paid first. That makes sense. Now, there is one last group of losers that hits a bit closer to home for some of our listeners.
The consumer PC and gaming sector.
This is purely a supply chain reality. Nvidia started as a gaming company.
But if you are running Nvidia and you have one wafer of silicon, and you can either turn it into a data center chip that sells for $30,000 or a bunch of gaming cards that sell for $500, what do?
You make the data center chip every single time.
Of course. And this creates a strict supply tightness for the consumer market. It affects companies like Logitech, ticker LOGI, and HP Inc., ticker HPQ.
Because if gamers can't get the high-end graphics cards to build new PCs, they aren't buying the other peripherals either.
Right. They aren't buying the new high-speed mouse, the mechanical keyboard, or the new 4K monitor. The whole build cycle slows down.
Logitech and HP rely on a healthy, high-volume PC market. If Nvidia is diverting all its manufacturing resources to the enterprise side, the consumer market just stays flat.
So if you are holding Logitech, you are sort of collateral damage to Nvidia's massive success in the data center. You are waiting for the crumbs to fall from the table, essentially.
All right, let's frame this for you as we look at the week ahead. We have the data points. We know who the hardware winners are and who is getting squeezed on margins. What is the bull case and the bear case right now?
The bull case is that Nvidia has de-risked the trade. There was a lingering fear that AI spending was a bubble that was about to pop.
But this guidance clearly says no. The spending is real, the checks are clearing, and the product roadmap is fully intact.
So that gives a green light to stay long. The infrastructure basket. Companies like SMCI Vertiv and Arista, it tells you the trend is still your friend, and the capex cycle has real legs.
And what about the bear case?
The bear case revolves around utilization. We know the chips are being bought in record numbers. We don't fully know if they are being used profitably by the end buyers yet.
The ultimate return on investment question.
Right. If the hyperscalers, Microsoft, Google, Meta, start coming out on their earnings calls and saying, okay, we bought all this stuff, now we need to pause and optimize.
Or they say, we need to figure out how to monetize this capacity before we buy more, then the whole trade re-rates lower very quickly.
Optimization is the scary word here. It is corporate code for we are closing the wallet for a bit.
So the next catalyst isn't actually Nvidia at all. It's the earnings calls from Nvidia's customers.
You need to listen very closely to what the cloud giants are saying about their capital expenditure plans for the rest of the year. If they hold the line on spending, the complex goes higher.
But if they blink, we rotate out of these names.
That is the exact setup.
It is a fascinating dynamic to watch play out. You have this one company acting as the heartbeat for the entire tech sector.
And right now, the heartbeat is remarkably strong, but the market is just demanding more and more proof that the rest of the body is healthy too.
Well, that is the landscape for you. From the silicon to the server rack, and from the liquid cooling pipes down to the consumer gaming mouse.
Just remember, in this market, the second derivative trade, the supplier to the supplier, is often where the real edge is hidden.
We will keep watching the flow of money to connect the dots. But before we wrap up, here is something to mull over. We've talked about the power grid being a bottleneck. But what happens when the physical constraint isn't just power, but actual geography? Where do you even put these massive 100-kilowatt server farms when every major metro is running out of viable industrial real estate? It is a physical limit that the market hasn't fully priced in yet.
That is definitely the next frontier of this infrastructure puzzle.
A quick reminder before we sign off.
Okay.
This content is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Thanks for joining us.
Thanks for listening to Breaking News to Trading Moves. We will catch you next time.